So it's a great evening. We meet again for a session of financial reporting and analysis. So today's topic is concerning accounting for income taxes. So this is a topic which affects published financial statements. When preparing the published financial statements, this small topic of today, you might find that it's part of the workings you are supposed to do. So when we talk about accounting for income taxes, you are supposed to be aware of on how you are supposed to compute for the current taxes and the deferred taxes. So that is under the accounting for income taxes. You are supposed to understand the two. So when we talk about the current tax, we say that it's all about the tax payable in the current year under consideration. Then the deferred tax is all about the provision for the future taxes. Is the provision for future taxes. Is the provision for future taxes. So accounting for income taxes. Income taxes are taxes payable during or after the financial period under consideration. So when calculating income taxes, they normally arise a difference between the taxable profit and accounting profit. So when calculating for the income taxes, they normally arise a difference between taxable profit and accounting profit. So the reason responsible for the difference may be classified into two. We have the permanent differences and we have the temporary difference. So remember that we have this aspect of taxman and we have an accountant. So we are saying that when computing for the income taxes, in short, they arise the difference between accounting profit and taxable profit. Remember that under taxable profit, for the taxman to arrive at the taxable profit, there are various items which a taxman considers So there are some expenses which a taxman considers to be allowable expenses and others disallowable. Unlike in accounting profit. So that is why they are saying that when computing for the income taxes, they normally arise a difference between taxable profit and accounting profit. So the reason responsible for the difference may be classified into two. So we have what we call permanent differences and the temporary differences. So in an exam scenario, you can be told to differentiate between the two. You can be told to differentiate between the permanent differences and the temporary differences. The permanent differences and the temporary differences. So when talking about permanent differences, a permanent difference is when an item has been considered. An item has been considered in one profit computation. An item has been considered in one profit computation, but ignored in the other profit computation. So when we say that an item has been considered in one profit computation, I mean that an item has been considered in, for example, taxable profit computation and ignored in the accounting profit computation. So an item is considered in the taxable profit computation and ignored in the taxable profit computation. So for example, now, when computing for the accounting profit, we have some expenses which are considered to be allowable expenses, which means that under accounting, there are some expenses which are considered to be allowable expenses, the one which are just deducted to get the net profit. But for the tax purposes, you will find that those expenses are disallowable. So examples of those expenses are like depreciation. We have things like impairment, we have amortization, we have donations. Remember, for accounting, for when doing the accounting profit, things like depreciation, things like amortization, donations, those are considered to be normal expenses. They are allowable expenses. But for the tax purposes, they are considered to be disallowable expenses. I think you did tax. You did the introduction to tax. Or about disallowable and allowable. So that is why we say that under the permanent difference is when one item has been considered in one profit computation, but ignored in the other profit computation, whereby you find that an item has been considered in accounting profit computation, but ignored in taxable profit computation. Like now you are told depreciation, directors, entertainment are treated as expenses in accounting purposes, but not allowed for tax purposes. Temporal differences, you find that yes, the items has been considered in both profit computations. That is both taxable and accounting. You find that an item has been considered in both profit computations, but in different time periods. In different time periods. That is based on accrual basis and accounting and cash basis. You will find that an item has been considered in both profit computations, but in different time periods. When we talk about different time periods, I mean accrual basis. An item is accounted based on accrual basis or based on cash basis. Remember that when we talk about accrual basis of accounting is whereby, like an expense, you recognize before you pay. If it's an income, you recognize before you receive that income. So we always say that temporal difference is equals to what? Temporal difference is equals to what? We always say that temporal difference is equals to the carrying amount minus the tax base. So the carrying amount minus the tax base. So that is the point whereby I can mention a bit of the formulas. So since I have explained what temporal difference, we always say that temporal difference, temporary differences is equals to, it's all about carrying amount you minus the tax base, of which carrying amount is all about the cost, you deduct accumulated depreciation. Then we have a tax base is all about the cost minus accumulated capital allowance, minus accumulated capital allowance. Minus accumulated capital allowance. Cost minus accumulated capital allowance, that is tax base. Or we have the carrying amount being cost minus accumulated depreciation. So of which we always have types of temporal differences, whereby we have taxable temporal differences, and we have the deductible. We have the deductible temporal differences. We have the taxable and the deductible. So for the taxable is when carrying amount is greater than the tax base. Deductible is when the carrying amount is less than the tax base. So the taxable temporal difference leads to the taxable temporal difference leads to the deferred tax liability, DTL. For the deductible temporal difference, it leads to deferred tax asset. So taxable temporal difference, whereby the carrying amount is greater than the tax base, it leads to the deferred tax liability. Deductible temporal difference, carrying amount is less than the tax base, it leads to the deferred tax asset. It leads to the deferred tax asset. And always when I will be talking about deferred tax, when I will be talking about deferred tax, I would always say that we always consider the balance sheet liability method. We always consider the balance sheet liability method. The balance sheet liability method, which fuels deferred tax, to arise from temporary differences, which fuels deferred tax to arise from temporary differences, so that your deferred tax will be temporary difference times the tax rate. The temporary difference times the tax rate. And since you know now how you get the temporary difference, is all about the carrying amount minus the tax base. You would be able to get your temporary difference, then you multiply with the tax rate, you get your deferred tax using the balance sheet liability method, which is recommended under International Accounting Standards 12. So that is this means that balance sheet liability method. That is what we mean. So before we go to the deferred tax, I mentioned deferred tax because of this aspect of temporary difference. But before we go to that route of talking about deferred tax, we need to understand something called current taxes, because all of these I have explained. Types of temporary difference. I've said we have taxable and deductible, whereby taxable is all about the carrying amount which is greater than tax base. It leads to deferred tax liability. I've talked about deductible temporary difference, whereby the carrying amount is less than the tax base, whereby meaning that the tax base exceeds the carrying amount, and it leads to deferred tax asset. So now we need to know types of income taxes. So the current tax and deferred tax. So the current tax and deferred tax. So those are the types of income taxes. So starting from the current tax, is all about the taxable profit. We always take the taxable profit times the tax rate. Taxable profit times the tax rate. How do you get taxable profit? So for the taxable profit, we always say that we take accounting profit before tax. Accounting profit before tax. We had the disallowable expenses. I'm writing in short, disallowable expenses. We raise allowable expenses. We raise the allowable expenses. So that is how you get the taxable. Accounting profit before tax. You add disallowable expenses. You raise allowable expenses. So once you get your answer from there, you multiply with your tax rate to get the current tax. Get the current tax. To get the current tax. So I think from there it's just to go to an illustration direct. Illustration, and I don't want to do this small illustration there. I want to go to the past paper illustration. We address this issue of current tax. Then I talk about deferred tax a bit. We do another illustration for deferred tax. And that would be the end of this IS 12. So let's look at 2012 past paper. December 2012 question 2. So, and this is the question here. They are saying differentiate between taxable profits, that is taxable temporary difference, differentiate between taxable temporary difference and deductible temporary difference. We have just talked about this some few minutes ago. I say that the taxable temporary difference is when the carrying amount is greater than the tax base. It leads to the deferred tax liability. For the deductible temporary difference is whereby the carrying amount is less than the tax base. It leads to the deferred tax asset. Number B, Equip Agencies Limited purchased an equipment for 4 million on 1st July 2008. Depreciation on equipment is provided on a straight-line basis at the rate of 25% per annum. During the 4 years, from 1st July 2008 to 30th June 2012, the profit after tax and allowed wear and tear charges for tax purposes was as follows. So we have the period from 1st July 2008 to June 2012 down there, you can see. You are given profit after tax. So be careful on this. It's profit after tax. So never think that there's a mistake here. There's no mistake done there. It's profit after tax. Then we have allowable wear and tear charges. They're asking about the corporation tax rates. They are giving you the corporation tax rate, sorry. What are they asking? Taxable profits, temporary difference, and deferred tax account. How do you get the taxable profits? How do you get the taxable profits? You have the formula. That is what you apply. We said that accounting profit before tax or after tax? It's before. So we say that accounting profit before tax, accounting profit before tax, accounting profit before tax, that is accounting profit before tax. You add the disallowable expenses. You minus the allowable. So remember that our question was concerning which type of company. So it was called, this company was called Equip Agencies. Equip Agencies. So we are computing taxable profits. We are doing the taxable profits. We are doing the taxable profits. So that is for the year. So our years were ending when? Our years were ending. So our periods are ending, and that is so we have the year 30th June 2009, 2010. So 30th June. So it was 30th June. So that is 2009, 2010, 2011. It was ending 2012. I think it was 4 years. It was 4 years. That is it. It was 4 years. 2009, 2010, 2011, 2012. So we always start from accounting profit before tax. So it's all about accounting profit before tax. And then you have after tax. How can you change that one to be before tax? So remember that we always say what? For example, if I say 1, or I say, let's say X, X is at 100%. Let's say my X is at 100%. If I minus 30%, that is 0.3X. So I will be able to get profit after tax. So I'm trying to create an equation. So which means that X minus 0.3X is equals to profit after tax, meaning that 0.7X is equals to the answer, which is after tax. Like now, our first answer was 800,000, the one which is after tax. So we can look for X, which is before tax, which is at 100%. So if I divide both ends by 0.7, so X is equals to what? X will be what?
1,142,857.
So that is 1142,857. So this is 1142,857. So meaning that when you would be converting the profit after tax to be before tax, you divide by 0.7. You just divided the answers you have for after tax. You divide by 0.7 so that you get those figures being before tax. So 900,000 divided by 0.7, 1285, 1285, 714. Then the third one is 950. You get 1357, 143. Then the last one is 850. And you get 1214, 286. So I'm just dividing the figures before tax. That is after, sorry, I'm taking the figures after tax. I divide by 0.7 to get before tax. And that is well illustrated. Why am I doing that? So then I add disallowables. I will add the disallowable. So the disallowable expenses, these are, for example, now the depreciations, donations, amortizations. So these are just expenses which are not contributing directly to the generation of the business income. But for tax, that is where you will be told more about them. So here we have, there was a depreciation on the asset at 25%. At 25%. So 4 million. 4 million times 0.25. So that is 1 million. 4 million times 25%, that is a million, a flat rate of a million. So remember that the disallowable, the first one is depreciation. So we have 1 million. We have a million. Then now after that we raise the allowable. So the allowable expenses are the things like wear and tear allowances. WTA, the wear and tear allowances. So the wear and tear allowances, so based on these percentages on the asset, so 4 million times 40%. So that is 1.6. Then the second one is 30. The third one is 20. The last one is 10. So the first one is 1.6. So if we take 4 million times 30%, 1.2. Then we have 1. We have 2, that is 20%. Here you get 800. Then the last one was 10%, which is 0.1. So that is 400. So you can do the summation. 1142. So what we have there is the taxable profit, which is 542,857, 1,085,714, 1,557,143, and 1,814,286. So to get the current tax, you just take your taxable profit, you multiply with the tax rate. Like now the tax rate is 30%. So if we take 542,857 times 0.3, so the first year you are getting on, it's 162,857. So do for the other years. So after we are done with the current tax, that is after taking the taxable profit times the tax rate and getting the figures down there. The next requirement the examiner was in need of is the temporal difference. And we always know that for you to get the temporal difference, you have to know about the formulas which are supposed to be used, of which we know that the temporal difference is all about, so the temporal difference is all about the carrying amount minus the tax base. We always say the carrying amount minus the tax base. And of which you know the carrying amount is the cost minus accumulated depreciation, of which the tax base is all about the cost minus accumulated capital allowance. So remember that we have 4 years. So I write years. So if we take a carrying amount, we minus the tax base, I will be able to get temporal difference. Of which if I take the temporal difference, I multiply with the tax rate, I will be able to get the deferred tax. I will be able to get the deferred tax. So carrying amount, tax base, temporal difference, deferred tax. So remember we have 2009, we have 2010, 2011, and 2012. So we have the 4 years. So we start from the first year. We start from the first year. Remember that we have just one asset, which is the plant. So the cost of the plant was, remember that this one is based on the assets or liabilities, but we have only one asset, which is the equipment. The equipment, which was purchased at 4 million. So it was purchased at 4 million. So meaning that if I take that 4 million, so for the first carrying amount, I can be able to get carrying amount because I would be taking the cost, which is 4 million, I minus accumulated a depreciation. So meaning that in the first year, it is 4 million minus 1 million. It will be 3. Because it's 4 million minus 1 million. So 1 million is this one. But now what about the second year? It will be 4 million minus. Now up to this point, the accumulated depreciation will be, the accumulated depreciation will be
2 million.
2 million. So now you minus here 2 million. So it's 4 million minus 2 million. Then the third year will be up to this point. So it's 4 million minus 3 million. So it would be 1 million. Then the last year now it's up to the end here. So it would be 4 million minus 4 million, 0. Let's talk about tax base, cost minus accumulated capital allowance. So our capital allowance is all about the wear and tear allowances. So the first year is 1.6. The first year is 1.6. So you take 4 million minus 1.6. So you get 2,400. That is 2,400,000. 2,400,000. So the next year will be 4 million minus up to this point. 1.6 plus 12.
2.8.
2.8. So 4 million minus 2.8. So that is 1.2. Then the third year will be up to this point. So 2.8 plus 800. It will be up to that third year, it is 3.6. So 4 million minus 3.6, that is 400,000. Then the last year it will be up to this point. So 3.6 plus 400,000, it's 4 million. 4 million minus 4 million, 0. You take carrying amount minus tax base, you get temporal difference. The first year it will be 600. The next year is 800. The third year is 600. The last year is 0. So to get the deferred tax, you get your temporal difference. You multiply the tax rate. You multiply 30%. So 600,000 times 0.3. This is 180,000. Remember, this is 180,000. This is 0. What about 800? This is 240,000. So the last column will assist us in doing the deferred tax account. That is why I introduced that last column for the deferred tax. And that is the last requirement they were in need of in this question of ours. They were in need of the deferred tax account. They were in need of the deferred tax account. So the deferred tax account is all about to record the provisions they made for deferred tax. So we have 209 is the first year. So if there was a balance brought down, of which for it to be in the debit side, the balance brought down, it must be a deferred tax asset. So if it's a liability on the credit side, so if the balance brought down can be either on the debit or credit. So if it's a deferred tax liability, this side. So, but there was no balance brought down from 208. There's nothing. So the only thing which was here, they made a provision of 180 this year for deferred tax, meaning that there is a this one will affect income statement. So I can even write income statement to avoid a lot of stories. So we have 180. So I can just say, I can reduce it to thousands. I say 180. So I can remove the 3 zeros and say shillings in thousands. So already it was in millions. Our question was in millions. Was it in millions? No, I can say in thousands because they never reduced it. So it's okay. I can say shillings in thousands. So shillings in thousands. So the provision they made there is 180 in the first year. So meaning that the balance carried down here is 180. So we close with 180. And here we close with 180. So the balance brought down in the next year, that is 2010. In 2010, the balance brought down is 180. So remember, this is 2010. Then in the next year, remember they made a provision of 60, because this 180, remember, it's a future provision for tax they made. Future provision for deferred tax. So which means that 240 is inclusive of the 180, because 180 is to cater for the future taxes. So they only made a provision of 60. That is 240 minus 180. So which means that to the income statement, we have a deferred tax expense. To the income statement, the 60. So that we have here 240. And then we close here with, because the balance carried down will be 240. So 240. So the balance brought down will be, that is 2011. The balance brought down here is 240. So then there was a reduction from 240 to 180. So meaning that there is a deferred tax income of 60 there. So that one comes to the debit side as a deferred tax income. So again, it affects income statement, but not as an expense, but a deferred tax income of 60. So that the balance carried down will be, 180. So that we have 240. So that in the last year, 2012, we have a balance brought down here of 180. And there's a reduction to 0. So income tax, that is an income statement, sorry. So to the income statement, so the 180 goes, that is just a reduction to 0, from 180 to 0. So we have 180 there. So that is an account. That is an account they were in need of. That is the account they were in need of. So, for example, if you were to prepare an income statement, remember that what could have appeared in the income part and under the expense. So under the incomes, we have this and this, these two, the one which are on the debit side, this one and this one. So that one's could have occurred. They could have appeared under the incomes. Then these two, you record as an expense. This and this one. So that is on the case whereby you are told to prepare an income statement extract. So you record the 180, this 180 and the second 180 as income tax expense, then the 60 and 180 as income tax. That is an income, a deferred tax. That is a deferred tax income. So this and this would be deferred tax expenses. 2009, 2010. Then the 60 and 180 would be deferred tax income. So let's look at the receipting question. So before I do the question of the receipting, I need to mention a bit about deferred tax. So deferred tax. what you need to know that deferred tax is all about provisions for the future taxes. It's all about the taxes you provide now, but they will cater for the taxes to be paid in the future period. So it's all about provision for the future taxes. So we have two methods for computing deferred tax. We have two methods. The first one being income statement liability method. The first one being income statement liability method. Income statement liability method. The second one being balance sheet liability method. Balance sheet liability method. Balance sheet liability method. So for the income statement liability method, so this method views deferred tax to arise from permanent differences. It views deferred taxes to arise from permanent differences, which is the differences between disallowable expenses. So the disallowable expenses, it's the differences between disallowable expenses and allowable expenses. So it's divided into three methods, whereby we have nil provision. This method is divided into three methods. The first one being nil provision method. We have the partial provision method. And we have the full provision method. We have the full provision method. So for the nil provision method, this one, it makes provision only for the computation of income taxes. There's no provisions for deferred taxes. That is nil. Nil provisions makes provisions for current taxes only. That is why it can never be recommended here. Then we have full provision. Before I talk about partial, full provision, it makes provisions for both current tax and deferred tax. So if we were to use this income statement liability method, the method which we can use here is the full provision, because it makes provision for both the current taxes and deferred taxes. So partial provision is the same as full. But there must be evidence that the tax will be refunded in the future period. That is, you check 2 to 3 years. Check 2 to 3 years. And in this method, that is the only thing you can be asked to differentiate, maybe. You can be asked to differentiate between nil provisions, partial, and full. Or you explain about the three. Because my second method here is the one which is recommended in the computation of the deferred tax. Because income statement liability method is not recommended. The balance sheet is the one which is recommended. And the balance sheet liability method, we talked about it. It views deferred tax to arise from the balance sheet liability method. It views deferred tax to arise from temporal difference. And you know what temporal difference? I have just talked about it earlier. So you say it's all about carrying amount minus tax base. You know, carrying amount is cost minus accumulated depreciation. And the tax base is carrying amount, that is cost minus accumulated capital allowance. So when the carrying amount is greater than the tax base, that is a taxable temporal difference. When the carrying amount is less than the tax base, That is a deductible temporal difference. So that is the method recommended, the balance sheet liability method. Then there's something I needed to mention about intangible assets, because when computing these aspects of deferred tax, they are always based on assets or liabilities, because the question which we are going to tackle will be based on the assets or liabilities. And before I mention that, remember we said that the method recommended in the computation of deferred tax is called the balance sheet liability method. Why? Why this recommended? You can be asked to justify why. So it's recommended because now, first, it views deferred tax to arise from temporal difference. And what about this temporal difference? So of which the components which it uses are based on the financial position. That is why I've said assets and liabilities. Unlike the income statement, liability method, which only focuses on incomes and expenses, which may fluctuate during the financial period. Remember the balance sheet. That is, it focuses on components of a statement of financial position. And this one shows the position of an entity. Unlike the income statement items, which will be used under the income statement liability method, which will be fluctuating from time to time. So I have said, I have to talk something concerning intangible assets. So when I will be doing deferred tax, you need to know that intangible assets are not assessed for tax purposes. Intangible assets are not assessed for tax purposes based on their tax base. Based on their tax base, rather on their carrying amount only. So intangible assets are not assessed for tax purposes, based on their tax base, rather on their carrying amounts only. Anyway, this one will come clear once I do this illustration. So that is, their costs are always allowed in full for tax purposes. And you need to know that goodwill is tax exempt. It should not be assessed for tax purposes, even if the carrying amount exceeds the tax base. So knowing that, we can look at this question in the next 10 minutes. We call it a resume for today. So this is the relevant question. They were saying that Sion Limited, a public limited entity. So this is the last question for April 2022. So this limited company, a public entity, is in the process of finalizing its financial statements for the year ended 31st October 2021. The following information has been extracted from its accounting records for the purposes of estimating the deferred tax balances. Inventory is stated in the financial statements at the law of cost and the net realizable value. Which standard is that for accounting? This is IS 2. Obvious, inventory is stated at the lower of cost and the net realizable value. That is IS 2. So the company wrote down its inventory by 120 million to a net realizable value of 1130. That is 1,130,000. The reduction in value is ignored for tax purposes until the inventory is sold. until the inventory is sold. Trade receivables had a carrying amount of 450 million after making a general provision for doubtful debt of shillings 30 million. The provision is not allowed for tax purposes. Property, plant, and equipment has a carrying amount of 3,050,000 and a tax base of 2,750,000. During the year ended 31st October 2021, the property was revalued upwards by 150. Number 4, during the year to 31st October 2021, development expenditure amounting to 480 million was capitalized. Amortization of shillings 20 million was charged to profit or loss for the year. This development expenditure was allowed for tax purposes in full during the year. Trade and other payables are carried at 600 million. Included in the other payables are accrued expenses of shillings 100 million, whose related expenses are deductible for tax purposes on cash basis. That is on cash paid basis. Number 6, deferred tax liability, 1st November 2020. So this is the balance brought down, amounted to 272. This one would be used when we are doing the account as balance brought forward. Income tax rate is 30%. Compute relevant temporal differences, 5 marks. Deferred tax account, 4 marks. That is 9. 9. So because that question was performed poorly, you never know the sitting if they can repeat. So let's look at that question. What about understanding the aspect of allowables and disallowables, and what's temporal difference, which you know. So that is April 2022. The last question there. So here they're asking about temporal difference, which is all about carrying amount minus tax base based on the assets and liabilities. Based on the assets and liabilities for that entity in that relevant period. So I will talk about assets, stroke liabilities. I will talk about carrying amount. I will talk about tax base. Carrying amount minus tax base. We get temporal difference. But I was in need of even tax. I was in need of even deferred tax. Anyway, we get temporal difference. So the first asset was being inventory. So inventory, they said, is stated in the financial statement at the lower of cost and the net realizable value. The company wrote down its inventory by 120 to a net realizable value of 1130. So the reduction in value is ignored for tax purposes until the inventory is sold. The reduction in value is ignored for tax purposes until the inventory is done what? Is sold. So what am I supposed to record as a carrying amount? What am I supposed to record as a carrying amount? So that is, it was reduced to 1130. So meaning that the 120 is done what? Ignored for tax purposes. So if you take 1130 minus 120 is
1010.
But now remember that they have said that it's ignored for tax purposes. So you cannot deduct, but you are supposed to add back to the initial net book value, to the initial net book value to get your tax base. So to get your tax base, that amount which was ignored for tax purposes, meaning that it's not an allowable amount, but a disallowable amount. So you take 1130, you add the 120. So taking 1130 plus 120, you get
1250.
So 1250. So 1130 minus 1250, that is 120. So that is a deductible temporal difference there. Deductible temporal difference. That is a deductible temporal difference. Then the next thing you talk about is all about the aspect of note 2, trade receivables. Trade receivables. It was having a carrying amount of So trade receivables had a carrying amount of 450. After making a general provisions of doubtful debt of 30, the provision is not allowed for tax purposes. So which means that it's a disallowable, the provision, which is supposed to be added back to the carrying amount to get the tax base. But the carrying amount you are given is 450. The carrying amount you have is 450. The carrying amount is 450. So meaning that under receivable, the carrying amount is 450. So provisions are disallowables under tax, or provisions are disallowable expenses other than the specific provisions. So 450 plus the 30, the provision, that is 480. So 480 is our 480 will be our tax base. So 450 minus 480, that is 30. Number 3, property, plant, and equipment had a carrying amount of 3050 and a tax base of 2750. So the carrying amount will be, so you have it 3050, and you have the tax base of 2750, but there was a revaluation. So during the year ended 31st October 2021, property was revalued upwards by 150. By 150. What does that one mean? So what you do there, you have to increase the carrying amount by the do you have to increase the carrying amount? No, there's nothing you have to increase, because remember that when we talk about revaluation will affect the deferred tax account. So meaning that here we have a carrying amount, of 3050, which is given direct, and we have a tax base of 2750. So there's nothing there to adjust. It's just taking direct as provided. That revaluation will affect our deferred tax account. So meaning the difference is 300, which is a taxable temporal difference, which is a taxable temporal difference. So the second last item, number 4. Number 4, which type of asset was there? Deferment expenditure. Remember that the expenditures or any cost you incur prior to the formation of an entity, it's an asset. Like now, deferment expenditure. So during the year to 31st October 2021, deferment expenditure amounting to 480 was capitalized. Amortization of 20 was charged to profit or loss for the year. This development expenditure was allowed for tax purposes in full during the year. Deferment expenditure was allowed for tax purposes in full during the year. So for 80, amortization is 20. Deferment expenditure was allowed for tax purposes in full during the year. So let's record this deferment expenditure. Let's record that development expenditure. So development expenditure, remember that it's an intangible asset. These are some, why am I calling it an asset? Because it's just an expenditure which was incurred prior to the formation of an entity. So you are told that it's amortized. It's amortized by 20, but it's relevant value at which it was stated is 480. Meaning that if it's amortized by 20, the value will reduce to amortization is the loss in value. And this amount is charged to the profit or loss. So 480 minus 20 is? That is 460. Then remember that when I was talking about intangible assets, I said they are not assessed for tax purposes based on their tax base, rather on their carrying amount only. So their costs are always allowed in full for tax purposes. Their costs are always allowed in full for tax purposes, meaning that our tax base will be 0. Their costs are always allowed in full for tax purposes. So meaning this is 460. The last one, trade and other payables are carried at 600. Included in the other payables are accrued expenses of 100. Whose rated expenses are deductible for tax purposes on cash paid basis. So payables. So payables, they are carried at 600. Included in the payables are accrued expenses. There are accrued expenses of 100, whose rated expenses are deductible for tax purposes. So which means that for tax base, I have to deduct 600. I have to take 600 minus 100 and get 500. But carrying amount, I have to state that at 600. I have to state that one at 600. So meaning that for the payables, remember payables is a liability. So that is a carrying amount is 600 and the tax base is 500. So I'm just deducting the 100, meaning that minus 600 minus 600 minus 500, it will be minus 600 minus 500. That is a negative 100. because that is a liability. I'm saying it's a negative because it's a liability. So add the temporal difference. So minus 120 plus minus 30 plus 300 plus 460 plus minus 460.
510.
So that is
510.
That is 510. Eh? So that is 510. So the examiner was in need of what? Temporal difference or what and what? He was in need of temporal difference. We have the temporal difference, and he was in need of a deferred tax account. Eh?
Yeah.
So we can be able to do that deferred tax account because for the balance brought down, we have it. Eh? So the balance brought down, we have. So if you take 510 times 30%, what are you getting? Because if you take your temporal difference times 30%, you get deferred tax.
Yes.
Yes, so which is?
153.
I can be able to do a deferred tax account. The balance brought down was? Remember, this is which type of first? For you to know which side to put your balance brought down and carry down. Remember, this 510 is positive, meaning that is a taxable temporal difference, which leads to deferred, tax liability. So the balance brought down was given, and the balance carried down is the one we have determined there, 153. The balance brought down was given at what value?
72. 272.
So that is 272. So I would be able to, I wanted to show you on how these, let's say we finish first, and I show you on how they marked this question. So the balance brought down is what about 250, that is 272. The 272, and that is given in the question. Eh? It's given in this question. So the last question there. So they mentioned somewhere here, note 6, deferred tax liability as at 1st November 2020. Remember our financial year ends at 1st October 2021. So we have 272. Then there was revaluation here. That revaluation of what? Property, note 3, 150. Eh? So what you do, you take 272 there, then deferred tax due to revaluation. Deferred tax due to revaluation is, so 30% of 150 is, 30% of 150 is, this is 45. Eh? So the balancing figure is in which side? So 272, remember that the revaluation increases this account. So there's deferred tax in that revaluation. So 272 plus 45, 317. Eh? 317. So meaning that there's a deferred tax income, eh? Because it's a reduction from 317 to 153 of 164. So there's a deferred tax income of 164. So if the examiner was in need of Just 2 minutes. I finish. If the examiner was in need of journal entries, let's say, for example, the examiner was in need of journal entries. What you record is this and this. So like now, we have credited revaluation here. So in revaluation account, we could have done what? Debited 45. And the credit the deferred tax account, the 45. You give narration. To record, the first narration you give is all about to record deferred tax due to revaluation. For this one, you debit the deferred tax account, the 164, you credit the income statement. You credit the income statement. So you say to record the deferred tax income. So that is the journal entries in case the examiner asks in an exam scenario. That is how you were supposed to do this question for us, as 18. And I think you have the marking scheme for that. I shared. So they were marking these entries. So one for one. 1 for 1. And for the account, they were very fair. Also 1 for 1. It's 1 for 1. So that is the end of the session today, and the end of this small topic for accounting for the income taxes. That is under International Accounting Standards 12. Have a great time, revise. And
Can you kindly share question with the answers?